Hello, this is John Cavalli of JK Financial. This is your January Capital Market Financial and Economic Review, and we are remotely from, I don't know if you can read that, but I'm actually on a road trip, and it's February 1st, and decided to shoot the video with a little extra time in between meetings. But I really have a special video for you this month because the markets have become choppy. I hope you enjoy it. So I'm going to go ahead and get right to it. We point directly to a couple of misconceptions that folks in the media have had. So again, thank you for your comments, your participation. Most of all, thanks for watching. Have a good day.
Break in. As you saw on the previous slide, this material has gotten pretty heavy, and as I had continued my trip from Oklahoma back to Dallas, I had thought about just how heavy this had gotten, and I'd reviewed the videos. And so what I thought we would do is each month this year and moving forward add a tip, and this one is the personal umbrella policy. We've talked about it before, but just in a quick review, I think a personal umbrella policy is something that is just worth its weight in gold. Basically, as you can see from the clip of the post that I've added in, the key characteristics are, well, one of the most important things is it's not very expensive and it gives you great peace of mind. It is added generally, whoever carries your homeowner's policy is who you would call to get it set up. It's hundreds of dollars, not thousands. I'm going down the bullets here. And when you implement it, it confirms your other coverages are appropriate, because you can't have failing coverages or minimal coverages underneath an umbrella. You have to have good coverages. Now, this is different from having low deductible. We are big high deductible fans, but that's for another. That's a topic for another time. Maybe a tip in the future. This kicks in. An umbrella policy kicks in when you really need it, and it's likened to major medical insurance. That's it. That's the tip. Hope you enjoyed it, and now we'll go back to the regular video. So thanks for your time. So January started the year out very interesting, much differently than 2013. Recently, a lot of commentators are pointing to the fact that it was the emerging markets. We would argue that it was not the emerging markets, and that it was something a little bit different. If you look closely, and we're going to show you quickly, the non-farm payroll report came out in early January. The expectations, we talked about this in a post earlier, the expectations were 190 to 200,000, something of that nature, and it came out at 74,000. That's a huge miss, abnormally large miss. Here's this is from Econo Day. You can see it is a little bit volatile, but look at the 74. Okay, a couple of things could be at risk, or a couple of things could have happened. It could have been a slowing in the economy, or it could be this polar vortex. I know in the month of December, by the way, the January report is for the month of December. I know in Dallas that we were almost locked down for a week. We had a very short Christmas season, and we were locked down because of the weather. So our bet is that this report, which coincides almost directly with our next item. Look at this. Okay, yeah, we get excited over this, but let's see if I can get this in the view here a little bit better. I guess not. The interest rate. This is the 10-year Treasury. Now we expect this. This is the actual rate of it. So right here it's at 3%. It finished the month out at 2.66. Why does this matter? Well, guess what? Here's where that non-farm payroll report came out, right in here. Boom, rates started coming down. We had some emerging market items here, and rates continued down. This is a problem. Why is it a problem? Well, rates are predicting something much greater than just a pullback. I don't know. We don't know exactly how to read it. Why are rates predicting something much greater? Because the Fed has now begun to take off QE. And what that means is they're slowly but surely pulling out of holding these rates down. So all other things being equal, the way these rates should have moved would have been upward if nothing else was going on, because the Fed's not in here buying as many. And they not only didn't go up as the Fed discontinued buying, but they went down. I'm not ready to throw in the towel and say, hey, we're in a tough situation like the bonds. If bonds are correct, we're really going into a slowing. Donald and I are not ready to say that yet, but we are on watch. So those are your two big items, and I'm going to go ahead and cut this video short. As you know, we're trying to do something remotely this time. So I hope you enjoyed it, and we'll see you next month.